Phil, so this morning we see more rough numbers, though perhaps not a surprise. Just like this market has cruised through all the jobless claims, it seems like they don't have a problem with the 14% drop in durable goods either.
Yeah, it's a little bit like the market's priced this in about a month ago, isn't it? And I remember a month ago everybody was panicking about why the market was down so much. Now the data is coming in to show why the market was down so much. And to a large degree, all these kinds of numbers, I mean, they're off the charts and they're not good for workers and for Americans, but they were expected. And so, you know, it's pretty much baked in based on all the data that we've already seen that's on a daily basis.
Phil, what's the best explanation you can think of here? Is it that the market is still prioritizing the literal virus count and the fact that curves continue to bend in a positive direction? Is that what's taking priority? Or are we looking at the data, and to your point, saying we understand this, but there's enough policy offset to where maybe a jobless print doesn't really matter if the jobless are still getting paid?
Yeah, I think it's a combination of everything. If you look at the market volumes, they peaked in the middle of March before the cases peaked. The cases in America peaked in about the first week of April. So we'd already started to look forward even before the cases got to their worst level. I would argue the last couple of weeks with the case slowly drifting down, the market's really not reacted to the new case information at all, and it's starting to look at things like the treatments and the news. It's starting to look at things like the amount of fiscal support that's being thrown at the market and how it's affecting workers and companies. And with more than 10% of the GDP coming out in fiscal stimulus now, that's a lot of extra cash. I know we were just talking about whether that's going to be inflationary, but it's going to plug a big hole in terms of all the GDP numbers that we can see from old-fashioned data coming down. It's potentially enough to offset a lot of the downside risk.
Yeah, I think this is probably the most important point, right? I mean, Phil, we've never really had this kind of action ahead of the crisis. There was an expectation that this was coming and some clarity that it was, and the action by the Fed really started even before the data arrived for either the case count or the economic fallout. So as opposed to previous crises where there was a response later after the damage had been done, how do we even model what the future looks like now, Phil? Because if we say, oh, these relationships of the past, this type of jobless claim will lead to this GDP, or this employment print will lead to this unemployment, how do we even know any of what that means when the consumers that are unemployed already are getting paid, and some paid even more than they were making before?
Yeah, there's a difference normally to the Spanish flu and how that worked, and that was a really short, sharp recession, even though the Spanish flu had a second wave almost a year later. So it's possible, and I think it's mostly expected, that this will be all over in 3 months. Largely, people will be getting back to normal. They might not be doing things like tourism and travel on planes, but we'll be starting to go back to shops. We'll be starting to get back outside. We'll have protective measures, whether that's heat gun work or masks in the street, but we'll be able to do things more normally. And we've seen Asia has obviously got that under control and started to get back to normal weeks ago now, and it doesn't look like they've had too much problem with cases reigniting. And Europe this week is starting to open up its economies and getting people back out in the streets and back into shops as well. So based on all the historic data of how this sort of virus filters through the economy, how the shutdowns do work to stop the growth of the caseloads, get the healthcare system under control, and then get people back to work with protective measures, it does look like 3 months is about all it takes.
Yeah. Phil, it's, I think, an important question to think about what the market is expecting for timeline. And we don't know, of course. Maybe somebody will do a survey at some point, and we can use that as a benchmark like they do other positioning surveys and such. But the point here is that yesterday, J.B. Pritzker, the governor of Illinois here, extended the stay-at-home order that was supposed to expire on April 30th to now May 30th. New York also, from Governor Cuomo, extended theirs last week. The markets seem okay with that. Does that mean that there are expectations this goes through May? What about a June? I mean, at what point do you think the extension of these orders will roil markets again?
Yeah, and I guess that comes back to the fact that there's enough fiscal stimulus in the system now to somewhat offset the economic impact on the corporate But we're starting to see with earnings season, some corporates talk about cash flow problems. We're seeing a lot of corporates coming to market globally for extra cash. They're coming to stock markets and bond markets. So eventually this will have, to your point earlier, an economic impact which is more like an old-fashioned recession where companies start to file for Chapter 11 or don't recover as quickly as we would have seen in something like the Spanish flu crisis. And I think that's the risk. You've got to start get people back to work at least in a slow way and incrementally so that we start to get things back on the rails.
Yeah, all right. Well, we've got another $480 billion of stimulus coming this week to add on to what we already have. So right now, it seems markets are comfortable with the trade-off here between the shutdown and the prop up. Phil Mackintosh, Chief Economist at the Nasdaq. Thanks for joining us, sir.